Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are looking at 5 different stocks that are high in quality and cheap in price. So as you know, the markets have been up and down in the last few weeks, in the last few months if you like. So for that reason, a lot of the companies that were overpriced are now coming back to fair valued, or they are undervalued at the moment. So in today's video we're going to look at 5 different stocks that are, that you could potentially add to your portfolio, or maybe almost there. Some of them are already undervalued, some of them are almost there at the moment. And apologies if my voice is still all over the place, but yeah, I'm getting better, but my voice is still just a little bit, I don't know, we'll see inshallah. So the first company we're going to look at is Williams-Sonoma. This company is actually sells loads of different products. They own the pottery brands, West Elms brand. They own loads of different kids decorations, furnitures, house stuff. I know I've seen them in the Middle East, so there are quite a lot of them in the Middle East. So when I went to Dubai and places like that, they actually do have it. So it's international, I think, in that sense. I haven't actually looked at the breakdown of their revenue, anything like that. So I'm just going to give you an overview. If you're really interested, you can look at it in more details. But this company is Sharia compliant. So if you're looking at a company to add to in the consumer discretionary, maybe this might be the one, because it is undervalued, and I'll show you that in a second. It's currently trading $142 per share. It has a PU of less than 10. The market right now, or the sector, the consumer discretionary, is about 25. And as you can see, it's just under 10. Price to free cash flow under 10 as well. It has EPS of 14. So that shows that this company is really quality, because if they can produce that sort of EPS, that must be really good. Market cap of $10 billion. In terms of economic mode, is a narrow, because to be honest, the products that they sell, anybody can come up with these products and sell it. So that's probably why it's narrow. But they obviously have a loyal customers. They have their brand names actually quite very well known, especially with families. Okay, annual dividend of 2%, of just over 2%, which is really great. 5-year growth rate of 12%. This is amazing. So the company is growing their dividends every 5 years about 12%, which is really good. They have been basically growing this dividend about over 15 years, and payout ratio is only 17%. Now, so if the 5-year growth rate is 12% and the payout is this low, then that means there's still room for improvement. Okay, so they can still up their dividends, and that's probably what they're going to end up in the next couple of years. So instead of worrying about dividend cut, you probably will get more of a dividend basically raises in the next few years. In terms of dividend safety, according to Simply Save Dividend, is 80%. About less than, anything below 61% is great. Above 61%, okay, it's not bad, basically. So up to 99% is the perfect, and anything below that is obviously, but normally what they say is anything below is a dividend safety below 61%, then that's a little bit questionable. So just be careful. They might cut their dividend and so on. Return on equity is 68%, which is absolutely brilliant. Okay, and then when you look at the quarterly revenue growth, okay, you're looking at about 9%, and then quarterly earnings growth of 30%. And the next 5 years, the analysts are predicting, okay, this company is going to earnings will grow about 11%. And that's really huge. That is amazing. That's like more, if you look at the tech companies, that's probably what they basically are like. Okay, so there's still growth in the business. And right now, according to Simply Wall Street valuations, it's under 50%. So their target price is $294 per share, and currently we're looking at $142 per share. So $294 per share. So it's 50% discounted at the moment, and according to Morningstar, it's 35% on basically discount at the moment, and target price of £227 per share. That's really huge. That's a lot more upside, basically 35% and 50%. Even if you get, say, 25%, that's still a lot of basically growth in that business, okay, in the share price. At the moment, I just definitely think it's a strong buy. okay, because it's a quality company. One thing you will do definitely before you start investing, if you're watching this video, okay, and you're really interested in this business, then go into their website, find out what they do exactly, look at the breakdown of the basically countries that they're in, revenue from the last few years, is it basically growing year after year? Based on this, that tells me it is, but you just need to do a little bit more due diligence and find out exactly what's going on. But according to this analyst here, Simply Wall Street and Morningstar, which uses, by the way, uses something called discount cash flow model. Okay, so they predicted basically where the share price should be right now based on their intrinsic value. So they're not saying at the end of the year this is where it should be. Basically, they're saying generally this is based on the business itself and the intrinsic value of the business. This is where the share price should be. So these companies, Simply Wall Street and Morningstar, both use a discounted cash flow model. So the next company we're looking at is Moodys. Moodys are, for example, they basically in the financial sector. They do a lot of the credit ratings for other companies and so on. They currently trading $341 per share. P slightly high in comparison to this to the financial sector. So the financial sector generally has a lower PE, okay, but when you look at their PE, is quite expensive. Based on price to free cash flow, it's a little bit expensive as well. Okay, but we will see what the analysts think about this business. Because remember, when you look at PE, you also have to think about PE in the last 5, 6, 7, 8 years, where it was. So when you look at their PE from the last 4, 5, 6 years, it might be basically around the same where it is, basically where it is now. Sometimes it could be cheaper, sometimes it could be a little bit higher. There's certain stocks that trade higher multiples a lot of their time. Okay, so you need to look into that, and you need to also compare it with like for like. So maybe look at companies like SPG for Global, for example, okay, or the S&P Global company, see what the PE looks like and compare it that way. You got EPS of $11.78, market cap of $31 billion. It has a white mode. They pay small dividend, just below 1%, and then 5-year growth rate of 11%, and dividend growth streaks of 21 years of basically increasing that dividend, payout ratio of 20%, dividend safety of 83%, and return on equity of 95%, which is really high. And then you've got quarterly revenue growth year on year of 19%, earnings growth, okay, year on year. So basically from in the last year or so is 36, but last quarter 36%. Okay, and then when you look at the next 5 years, so what the analysts are estimating, the expected growth estimates of 13%, which is quite good. Simply Wall Street says is about 7% undervalued at the moment. The share price should be about $355 per share, currently 341. So not a lot of upside, about 7%. Then Morningstar is about 12%, again similar sort of a closer price, slightly higher, $375 per share. I think it's a moderate buy. I will say if you already have the big company and you're up, maybe don't add to it, wait until it goes down below your average and then maybe add to it. If you don't hold it already, maybe you can nibble it, you can just buy a little bit here and there, but in my opinion, I will say it's a moderate buy. Hold if you already have it, but definitely not a sell, because it's a great company. According to their numbers, basically it looks like it's actually a great business to own. Okay, so it's definitely high quality. And again, the other thing is when it comes to credit ratings and providing assessments and all of that stuff, it doesn't really take a lot of overheads, so a lot of their profit actually goes back into their pockets. So because they've developed those systems and they're not really producing actual product, if you like, they're analyzing data and basically giving out credits and so on. So it's like a nicer business model, if you like. The next company we're looking at is 3M. I know 3M we've talked about a lot in my portfolio, in my channel quite a bit, and it's down quite a bit at the moment because of some legal situation that's going on. But genuinely, is that going to be an issue in the next 4 or 5 years? I don't think so. And that's the reason why I own it. I've been buying more of it since it went down. And I think it's great quality. It's a great company. They basically got 4 different segments of their business. They've got safety side of it, industrial safety and industrials, transportations, electronics, healthcare, and consumer. And each sector, okay, is almost as big as, like having a Procter & Gamble section, whatever. So their segments are quite big, and they are, $86 billion. So they're not a really small company, okay? And this is the reason why I don't genuinely think whatever is going on at the moment with the legal side of it, it will clear up in the next couple of months, if not a couple of years. And by then we will forget it, and the company will go back to their intrinsic value. Because that's the most important thing. You need to look at the intrinsic value of a business and evaluate it based on the data, not based on some sort of a legal situation that's going on. Yes, they might end up paying some, fine, whatever. And if that happens, the company will just deal with it when it comes. But for now, the company looks, valuation-wise, okay, it looks really attractive. Okay, so when you look at current price of $150 per share, PE of just 14, the sector is about 23. We're looking for less than 20, which is basically definitely meets that criteria. Price to free cash flow, again, similar to the PE, which is quite interesting. And then EPS is 10. Market cap of $86 billion. It has a white mode according to Morningstar. They pay dividend. Their dividend is almost now 4%, which is quite good because the price share price went down. And then you got 5-year growth rate of 6%, dividend growth streak of 63 years. So 63 years this company has actually increased their dividend, and that's absolutely amazing. And payout is only 58%. Now, what that means to me is they still have a room to improve it, so they can actually give us more if they wanted to. Even though this 5-year growth rate is only 6%, they can increase that next year because they have the capacity to do it, because they're only using 58% of their net income to pay us the dividend. So dividend safety is about 75%, which is very high. Return on equity, okay, 42%, very high. Quarterly revenue growth, okay, it's flat because of COVID and whatever is happening last year, because commodities, actually the prices of commodities, the prices of the goods and whatever is gone up. For that reason, I think that's probably why these two are down. But remember, we're looking at quarterly. We're just focusing on just one quarter and then comparing it with this time last year, okay, and that's not healthy. But again, if this was going up, then you will know obviously the business is heading in the right direction. Right now, it seems this is down, but there are reasons why this is down. Okay, it's not because the company has no longer, it's no longer growing. This company actually has so much patents. Okay, they have so many. They're very innovative product company, and they produce in terms of safety, industrials, and whether it's come healthcare and consumer. They have so many products they patented. Okay, and they are innovative. Every single year they have thousands of products and thousands of patents, because they were the first to invest, basically to innovate those products. So for that reason, I don't think this is I have nothing to worry about. Okay, and the next 5 years you expect about 7% growth from a business basically that hasn't done well. Okay, this year, if you can get 7%, that's absolutely brilliant. In terms of valuations, okay, simply Wall Street says 47% almost undervalued. Target price of $279, 279, and right now we're looking at 150. So that's a lot of upside. That's 46%, which is quite good. And then you got 22% discount when it comes to Morningstar, $192 per share. I will be honest with you right now. If you have it already, hold it. If you don't own it, I will say, I'm not a financial advisor, but I will be buying, like simply. Okay, I have been buying. I will be buying more. If it goes down, I'm going to keep buying it because I genuinely do like the company. I like the 4% dividends. Okay, I like the growth of that dividends. I like how long they've been paying. Okay, and they have a free cash flow as well. So I'm happy with the company, and I'm going to hold on to it. The next one that we're looking at is Lam Research. This is in the semiconductor company. In terms of the services, semiconductor processing, equipment, and things like that. So they don't actually create it, but they have the equipment. Okay, so they service the equipment and things like that for the semiconductor manufacturers. So they are in the information technology sector or semiconductor sector. Apologies, my phone just went off. Apologies if you heard the phone going off in a bit. So current share price is $553 per share. When you look at this, sometimes you think it's too expensive because the price is actually, and the share price is expensive. But when you look at the PE ratio, look at only 17, okay? Price to free cash flow here, only 19. And then EPS, 32 EPS. That's ridiculous. It's probably the biggest I've seen in ages. Okay, then you got market cap of $77 billion. It has a wide mode. It pays 1% dividend. He's been doing this for 5-year growth rate of 34%, and has actually increased this dividend over the last 7 years. Payout ratio only 17%, so they definitely have room to improve. To improve that. If they wanted to, they can pay you more if they wanted to. Dividend safety 66%. Free cash flow of $4 billion right now. Beta 1.26, and then current ratio of 3%. Profit margin of 28%, and return on equity of 77%. Then you've got quarterly revenue growth, or year-on-year, 22%. Quarterly revenue growth of earnings growth, of 37%, 37.5%. And the next 5 years, they expected this business to grow about 16%, which is really good. And then top of that, it is undervalued at the moment, 42%. According to Simply Wall Street, the price should be $964. According to Morningstar, it should be $720, but right now it's 23% discount, and I will say it's definitely a strong buy. Okay, looking at this sector, I absolutely love this company. My only issue is I have KLA, which is quite similar, okay, in terms of what the things they actually provide. For that reason, I don't know. I'm going to still hold on a little bit, maybe see if I can do a little bit more research around the company and the difference between the two companies. I haven't had the chance to look at that yet. So I'm going to start comparing the two. And if KLA and this business have literally, in terms of their products and stuff, are different, then I might as well just add this to my portfolio, because I love the technology sector. I love the semiconductor and basically understand how they work and things that they do. So yeah, I'm tempted, definitely. Right, so the final company we're looking at is Medtronic, is a company that I actually own in my portfolio. They develop and manufacture therapeutical medical devices for chronic diseases. Again, I don't know a lot about the health side of things, okay? Alhamdulillah, I'm healthy and things are okay. I'll never use their products, but I actually have a friend whose basically child has got diabetes, and some of their products actually they use comes from Medtronic, okay? So it's a big, huge company worldwide. It's not just based on the US or the island, but it actually has a massive market cap of almost $150 billion, okay? Currently trading $112 per share. P about 30, the market's about 25 right now, okay? Price to free cash flow or 26%. Now this is important, okay? And what I want you to do is look at Medtronic's PE ratio and price to free cash flow over the last 7-8 years. You will find it's around 25 to about 30, okay? So it's within the range, if you like, okay? EPS of $3.83, market cap of $150 billion. Economic mode, when it comes to that, so having a competitive advantage, we're looking at about a wide mode. Annual dividend yield of 2.26%, 5-year growth rate of 9%, dividend growth streak of 43 years in a row, payout ratio of 44%, dividend saved of 99%. That's absolutely beautiful to see, okay? Why? Because they've got a lot of cash in the bank, okay? Beta is quite low. Current ratio is quite high, which is good. We want more than one. Profit margin about 15%. Return on equity about 10%. Last quarter, okay, it hasn't done well in terms of the revenue, but in terms of earnings growth, okay, it grew their earnings about 16.5%, which is quite good, okay? And then you've got growth estimates in the next 5 years, about 12%. Absolutely solid business, okay? So Simply Wall Street says is 16% undervalued at the moment. The share price should be $131. Morningstar says about 15%, and it should be 129. So they're very, very similar in terms of their predictions. Is definitely strong buy according to me. I will be buying, I will be adding to it as well. So yeah, there you have it. Basically 5 different companies. They're all different. Okay, they're all undervalued at the moment. They're all quality businesses. Okay, the only one that you might have a question, I might have a question mark next to, is 3M. Okay, Moodys is actually undervalued, but at the same time, I will say it's a moderate buy because the PE and so on. So if you can get it, maybe 25 will be better. Under 25 PE. But again, when it comes to Lam Research, I absolutely love that business, and Medtronic is another one that I absolutely love, and I own this one as well. I hope you enjoyed the video. Okay, if you do this, like this kind of content, and you are enjoying this, please just like that, just give it a like and subscribe to the channel. That's all I ask, because I'm not asking you to buy a course or anything like that. I just want people to, I'm just sharing my journey. Okay, and all I need from you is just to give that video a like, and so hopefully more people can see. Assalamu Alaikum, take care, bye bye.